The new industrial state, why the US is staking its future on companies like Intel, INTC. Introduction, the silent revolution in US capitalism. For most of the last 4 decades, American capitalism has been defined by a simple mantra: let markets decide. The government set the rules, corporations played the game, and investors allocated capital to where the highest returns seemed to lie. The state, at least in ideology, was supposed to be the referee, not a player on the field. But beneath the noise of quarterly earnings reports and the chatter of Wall Street analysts, a deeper revolution is quietly unfolding. The United States, long the champion of laissez-faire economics, is rediscovering the power and necessity of industrial policy. It is no longer satisfied to let the invisible hand guide its most strategic industries. Instead, it is planting visible, deliberate stakes in companies that sit at the commanding heights of the modern economy: semiconductors, clean energy, defense, artificial intelligence, biotechnology, and quantum computing. Intel's multi-billion-dollar support under the CHIPS and Science Act is the most visible emblem of this shift. Once the undisputed king of microprocessors, Intel spent the last decade stumbling, losing ground to Taiwan's TSMC and South Korea's Samsung. Yet instead of letting market Darwinism finish its course, Washington has stepped in not just to rescue Intel, but to repurpose it as the arsenal of democracy in silicon. Why? Because semiconductors are no longer just about laptops or smartphones. They are the nervous system of everything: fighter jets, 5G networks, energy grids, AI supercomputers, and medical devices. To outsource chips is to outsource national sovereignty. And to depend on Taiwan, a self-governing island that sits under the shadow of Beijing's threat, is to hold the fate of the 21st century economy hostage to geopolitics. This is why America's capitalism is changing. What we are witnessing is the rise of strategic capitalism, a system where government subsidies, guarantees, and restrictions are deployed not merely for economic growth, but for survival in a new era of techno-geopolitical rivalry. It is a model that borrows tactics from China's state capitalism, yet adapts them to America's entrepreneurial ecosystem. In this essay, we will explore why the US is making these moves, what the endgame looks like, how it resembles and diverges from China's approach, and how it reshapes the stock market and capitalism itself. Part I: Why the US is picking national champions again. Semiconductors as the new oil. If oil defined the geopolitics of the 20th century, semiconductors define the 21st. Every modern technology, from the iPhone to the F-35 fighter jet, relies on silicon. Yet the US, birthplace of the chip industry, allowed manufacturing dominance to drift overseas in pursuit of lower costs and higher efficiency. Today, Taiwan produces more than 90% of the world's most advanced chips. South Korea handles much of the rest. The United States, despite being home to chip design titans like NVIDIA, AMD, and Qualcomm, manufactures less than 12% of the world's chips, and almost none of the cutting-edge ones. This dependence is not just an economic risk, it is a strategic vulnerability. If Taiwan were ever blockaded or invaded, the global economy would seize up. Cars would stop rolling off assembly lines, supercomputers would go idle, military readiness would collapse, the lifeblood of modern society would be cut off. This is why Washington has chosen Intel as its semiconductor champion. Intel is not perfect, its technology lags, its execution has faltered, but it is American, deeply embedded in the defense supply chain, and capable, with enough capital and support, of regaining ground. By subsidizing Intel's fabs in Arizona and Ohio, the US is not just bailing out a company, it is building a strategic shield around the nation's technological infrastructure. The subsidies are not investments in profit margins, they are investments in sovereignty. From free markets to security markets. In the 1990s and early 2000s, efficiency was everything. Corporations hollowed out domestic manufacturing to chase cheaper labor abroad. Just-in-time supply chains optimized costs down to the penny. The assumption was that globalization was permanent and peace was the norm. But that assumption has collapsed. The pandemic showed how fragile supply chains truly are. Geopolitical tensions with China revealed that efficiency can be a liability when adversaries control your critical dependencies. We are now entering what could be called the era of security markets. It is no longer enough for a company to be profitable, it must also be resilient. The government is no longer just an umpire, it is a strategic investor, nudging markets toward outcomes that protect national security. Intel's subsidies reflect this paradigm shift. The goal is not maximum profit at minimum cost, it is maximum resilience at an acceptable cost. The China factor. At the heart of this shift lies one word: China. For decades, China studied and copied the US model, then supercharged it with its own twist: massive state subsidies, industrial planning, and aggressive technology transfer. Programs like Made in China 2025 openly declared Beijing's intent to dominate sectors such as AI, robotics, EVs, semiconductors, and biotech. The US long dismissed this approach as inefficient, but today it sees the results. China is now the largest market for EVs, a leader in 5G, a competitor in AI, and is catching up in semiconductors despite export controls. Washington's response: if you can't beat them with ideology, match them with strategy. That is why America is now doing what it once mocked: picking winners, subsidizing industries, and using the state to bend the arc of capitalism toward national security goals. Part II: is America becoming more like China? The ideological shift. This is perhaps the most striking development. The ideological guardrails of American capitalism are shifting. For most of the 20th century, American politics was built on the belief that government intervention in the economy should be minimal, except in wartime. The private sector was the engine of growth. The state merely set the conditions. But in practice, the US has always had moments of industrial policy in disguise. The space race, DARPA funding, the interstate highway system, nuclear energy, all were massive government interventions that seeded private industry. What's happening today is a more explicit return to that tradition. The CHIPS Act, the Inflation Reduction Act, and the Bipartisan Infrastructure Law all amount to a reassertion of the state's role as a co-architect of industry. Strategic capitalism versus state capitalism. It is tempting to say the US is becoming China, but the reality is more nuanced. China's system is state capitalism, government ownership, direct control, and long-term industrial planning. Companies may be listed on stock exchanges, but their true shareholder is often the Communist Party. America's new system is strategic capitalism. Private companies remain private, but the state directs flows of capital and constrains strategic choices. The government does not own Intel, but it subsidizes Intel, restricts Intel from selling advanced chips to China, and ensures Intel aligns with national priorities. The key difference is execution. China's model is centralized, but often plagued by inefficiencies and overcapacity. America's model is decentralized, chaotic, but powered by the dynamism of private markets. By combining subsidies with competition, the US hopes to achieve the best of both worlds: state-guided priorities executed with market-driven efficiency. Lessons from history. This isn't the first time America has done this. World War II, the US government directed industrial production, converting car factories into tank factories and creating defense giants that still exist today. Cold War, DARPA, NASA, and military contracts funded the early semiconductor industry, the internet, and GPS. 1980s Japan panic. Fearing Japan's rise in chips and cars, the US funded Semitech, a consortium to revive semiconductor manufacturing. In each case, industrial policy was used to confront existential challenges. Today, the challenge is China. The difference is that this time, the competition is not just military, it is systemic and permanent. Part III, the end goal. So what is America's endgame in all of this? Is it simply to restore Intel's glory days, or is something more profound at play? 1. Technological sovereignty. The US government has realized that true sovereignty in the 21st century is not just about borders or armies, it's about control over critical technologies. In the industrial age, sovereignty meant control over steel, coal, and oil. In the digital age, it means control over semiconductors, AI, biotech, quantum computing, and energy storage. These are the commanding heights of the modern economy. Whoever controls them doesn't just dominate markets, they shape the future of civilization itself. Intel is central here because chips are the base layer of everything else. Without advanced fabs, there is no AI, no 5G, no hypersonics, no autonomous systems. To cede chip manufacturing to Asia is to become strategically dependent, like Britain in the 1970s when it imported Middle Eastern oil at the mercy of OPEC. Washington has no intention of repeating that vulnerability. By securing domestic fabs, it is building the foundation of technological sovereignty. 2. Decoupling from China. But sovereignty is only half the story. The other half is decoupling from China. For decades, US corporations happily sold chips, tools, and software to China, seeing it as the largest growth market in the world. But the mood has changed. Export bans on NVIDIA's AI chips, restrictions on ASML lithography tools, and controls on advanced semiconductor equipment all signal one thing. The US wants to slow China's rise in strategic technologies. This isn't just commercial competition, it's techno-containment. If China achieves parity in chips, AI, and quantum, the US risks losing not only economic leadership, but also military dominance. Thus, Intel's new fabs in Arizona and Ohio are not just factories, they are fortresses in an economic war. Every wafer etched on US soil is a small victory in the broader strategy of techno-decoupling. 3. A parallel globalization. The larger vision is the creation of two parallel systems of globalization. A US-led bloc anchored around allies like Japan, South Korea, Europe, and India. A China-led bloc centered on its belt and road partners, Russia, and parts of the global south. Each bloc will have its own chip supply chains, its own AI ecosystems, its own payment rails, even its own internet governance. The dream of one seamless global economy is fading. What's emerging is a bifurcated techno-economic order. The US is staking its claim to lead the Western Bloc by ensuring that the foundational technologies are produced within its own borders or those of close allies. Intel's resurgence, Micron's expansion, and TSMC's Arizona fab are all pieces of this larger geopolitical chessboard. Part IV, implications for the stock market. This tectonic shift in policy doesn't just reshape geopolitics, it reshapes how investors must think about markets themselves. 1. Valuation distortions. In the past, investors valued companies purely on fundamentals, revenue, margins, growth prospects. Today, a new factor has entered the equation: strategic importance. Intel, for example, has lagged NVIDIA and AMD in technology and profitability, yet its market position is being buttressed by billions in subsidies and political will. That gives it a kind of strategic premium in valuation. It may not earn it through competitive edge, but through geopolitical necessity. This introduces a distortion. Firms aligned with Washington's strategic goals may enjoy higher multiples regardless of traditional fundamentals. Defense primes like Lockheed Martin or Northrop Grumman have long benefited from this dynamic. Now chip makers, rare earth miners, battery recyclers, and grid storage firms may as well. 2. Rise of strategic multiples. We can think of this as a new category, the strategic multiple. Just as growth multiples value future expansion and value multiples look at balance sheets, strategic multiples reflect a company's alignment with national security priorities. Investors will increasingly ask, is this firm systemically important? Is it aligned with U.S. industrial policy? Will it receive subsidies, contracts, or protection? If yes, it deserves a premium, even if margins are slim. This flips the traditional logic of Wall Street. In the past, governments followed markets. In the new era, markets follow governments. 3 new winners. Who stands to gain? Intel INTC, the chosen champion of US fabs. Micron Mu, ensuring DRAM sovereignty. Global Foundries, GFS, alternative foundry capacity useful for defense and industrial applications. Wolfspeed Wolf, leader in silicon carbide, essential for EVs and power electronics. Applied Materials, AMAT, critical supplier of semiconductor tools for reshoring fabs. Skywater, SKYT, small but important US foundry for trusted defense chips. Li-Cycle, LICY, battery recycling, part of energy security strategy. Fluence Energy, FLNC, grid-scale storage, critical for renewables integration. These firms may not all be the most profitable today, but their alignment with strategic policy gives them staying power. 4 market becomes geopolitics-driven. This also means investors can no longer analyze stocks in isolation. Earnings reports matter, but so do government bills. CHIPS Act funding, export bans, subsidy packages, these will move markets as much as product launches. The stock market is no longer just a financial arena, it is a geopolitical battlefield. Part V, the risks. Every grand strategy carries risks. America's new industrial state is no exception. 1. Corporate complacency. One danger is that subsidies shelter underperforming firms. Intel, despite billions in support, could still stumble. Bureaucratic protection may breed complacency, just as it did with U.S. Steel in the 1970s. If companies rely on Washington's money rather than true innovation, America could find itself propping up national champions that are too slow to compete globally. 2. Global retaliation. Another risk is retaliation. Europe, Japan, and South Korea are launching their own subsidy programs. China is pouring more money into domestic champions. The result could be a subsidy arms race that distorts competition and inflates costs. Instead of efficient global markets, we may see fragmented, politicized industries where location matters more than efficiency. 3. Inflationary pressure. Reshoring is expensive. Building fabs in the US costs 30–40% more than in Taiwan. Labor is pricier, permitting slower, and supply chains less dense. These costs will filter down into products, potentially raising prices for electronics, vehicles, and clean tech. Strategic resilience may come at the price of higher consumer inflation. Part VI, long-term consequences. What does all this add up to over the next decade? 1. A new techno-mercantilism. We are entering an era of techno-mercantilism, where technology is treated as a national resource to be hoarded, subsidized, and weaponized. Just as 18th century mercantilists hoarded gold and colonies, today's states hoard fabs, batteries, and AI talent. 2. Blurring of public and private markets. The line between public companies and public utilities will blur. Firms like Intel, Micron, and Wolfspeed may be technically private, but in practice, they will operate as extensions of national policy. Investors must recognize this. The balance sheet is no longer just a corporate ledger, it is a tool of statecraft. 3. The return of the industrial state. Above all, this shift marks the return of the industrial state. For decades, neoliberal orthodoxy told us that government intervention was an anomaly, but history tells a different story. America's greatest technological leaps have always been driven by state intervention, whether in war, space, or Cold War competition. Today's investments in Intel and its peers are not exceptions. They are a reversion to the true historical norm. Conclusion: the future of capitalism itself. What does it all mean? It means that America's model of capitalism is mutating. The US is not abandoning markets, but it is no longer leaving them fully alone. It is selectively adopting aspects of China's state capitalism, but bending them to American DNA. Subsidies without ownership, direction without command, industrial strategy powered by private execution. The endgame is not simply to make Intel more profitable. It is to ensure that America remains sovereign, resilient, and dominant in the technologies that will define the century. For investors, this means a new playbook. No longer can we rely on earnings alone. We must read bills, not just balance sheets. The companies of the future will be those that are not only innovative, but aligned with the state's strategic imperatives. The stock market is becoming geopolitical. Capitalism is becoming strategic. And the United States, in staking its claim on companies like Intel, is signaling that the rules of the game have changed. The invisible hand is still there, but now it wears a glove of steel.